Hi there. So welcome to our next topic, that is risk management. Now, if you remember from the introductory discussion, when we started with this journey on the overview of the syllabus, I mentioned that the CFO, that is the Chief Finance Officer, helps the business or assists the businesses in the making of four major decisions, and we mentioned that these decisions are core to the success of any organization and also help the organization in order to gain competitive advantage within the industry that it is in. We mentioned that among other things, the CFO helps the business in making of investment decisions. This has to do with what kind of projects do we invest in, what kind of vehicles do we buy, is it financially viable. We spoke about, do we have to buy a business or start our own business. All of these things are relating to investment decisions, and we did a thorough understanding of investment appraisal, and then we also talk about the issue about acquisition and measure, and then we mentioned the issue about business valuation. All of these things are in relation to investment decisions, because all of these decisions are what the financial manager helps the business in making. Then we said that when we identify what we want to do, maybe we want to launch a new product, we want to buy a new machine, or we want to undertake a project, we need to find out about the second decision, which is financing decision. This answers two questions. One, where do we get the money from, and then what is the cost of the money? So where we get the money from, we said it is the sources of finance, and we discussed the issue under business finance and discussed the various sources of finance that is available for the company. That is available for the company. We spoke about the short-term sources of finance, the long-term sources of finance, and then on top of that, we asked ourselves, we need to value how much it will cost us to obtain the revenue that we are looking for, and that is what we call cost of capital. And we looked at cost of equity, we look at cost of debt, and we look at the weighted average cost of capital. So that is also about the financing decision. Where do we get the money from in order to finance the projects we want to undertake, or in order to finance the investment decision that we want to undertake. Then we said that financing decision is closely related to the third one, which is the investment decision. Which is the dividend decision, all right? Which is the dividend decision. So the first one is investment decision, second one is financing decision, and then the third one is dividend decisions. So we mentioned a lot about the various factors that companies must take into consideration when they are making dividend decisions, and we spoke about the various factors they have to consider, the effect of whatever policy that they make. Now, the reason why dividend decision is also important is that it relates closely to the financing decision, because if we pay a lot of dividend out, that means that we will not have much money, retained earnings, in order to finance our project. Because if you remember if you remember what we mentioned in relation to I want to remember this thing. Okay, it will come. When it comes, I'll drop it down. Now, we first time when we are solving, or when we are looking at the sources of finance, one of the things we do is we consider our retained earnings. Do we have enough money, right? So that is the hierarchy that we follow, okay? So when we are looking at sources of finance, we follow that hierarchy. So we look at the retained earnings. If we have enough retained earnings, then we use our money. If not, then we look at debt finance, and then we discuss why debt is prioritized over equity from the shareholders. So how much dividend we pay will determine how much money that we have as surplus cash that will enable us to reinvest later on in the future. Then the fourth decision, the final decision, which is where we are at, is risk management decision. Now, this is a very key decision by the CFO because of the issue about globalization. Now, many companies now sell their products in various markets across the globe. They have suppliers, they buy from people outside and they sell to people outside. So the companies are always faced with what we refer to as foreign exchange risks. The risk that there is going to be a negative movement in the currency. Here in Ghana, we've been observing that with the Ghana cedis, right, where the Ghana cedis is increasing. with other foreign currencies. Now, so who are the people complaining? The businesses who are engaged in international trade are complaining now, because they are going to have the effect of that. What will happen is that in turn it will affect the rate of inflation for the general products, goods and services, because they go and buy the products from outside and they sell it inwardly, or the manufacturing companies and the firms, they go outside, buy inventories or raw materials from foreign suppliers, and they have to pay the money either in dollars, in euros, or in pounds. When there is a negative movement in the currency like that, it affects the business. So risk management has two legs. The first one is in relation to international trade. The fact that due to globalization, the businesses are established and doing businesses with other individuals and entities across the globe. Then the second thing also is that the issue about lending or borrowing has also brought a risk that businesses must analyze and look out for, especially from the perspective of the CFO. Now, you know that many businesses borrow. Now, they prefer to use OPM, that is other people's money, in order to undertake their project, and that is good. Every billionaire that you know about is using a huge amount of debt in order to keep their businesses running, or in order to keep their portfolio of investments going. So borrowing has also brought a lot of risks about businesses, and that is what we refer to as the interest rate risk. That is, sometimes we have an investment decision, we want to undertake a project, but then we intend to borrow the money. Now, we intend to undertake the project maybe 2 years time, but sometimes what will happen is that now the interest rate may be, say, 25%, but 2 years later, the rate of inflation and other economic factors will come into play, and so the rate of inflation is likely to increase to somewhere around 30% or 35% if we really need the money. So all of these risks are what the company is exposed to, and these are related to financial risks. So we have a risk that is coming from international trade, and that is the foreign exchange risk, the negative movement in the foreign exchange. Then borrowing, that is the interest rate risk. But then when these risks are there, the job of the CFO is to find ways and means for the company to be able to hedge. So the crux of this topic is hedging. That is, how would the company find out in order to hedge and reduce the effect of the negative movement in the foreign currency, or to reduce the negative movement in interest rates. So if, for instance, we know that there is going to be a negative movement in the currency maybe in 3 months time, what can we do today in order to protect ourselves against that? If we know that the interest rate is increasing and it will continue to increase, and we are going to be borrowing some money in the future, how do we find a way to reduce the effect of that? So these two are all standing on the hedging technique. So any company that will be able to hedge itself properly or efficiently against negative movement in foreign exchange and then negative movement in interest rates, that company is not going to face any problem in relation to those risks, so that the company can focus on other things. But as you see it like that, it's an area, as I mentioned earlier, students struggle with. I've met hundreds of students who, when we are talking about advanced financial management or even financial management in level 2, the first thing that they mention is about risk management, because students find it a bit difficult to be able to understand the concept, understand the principle, the various hedging techniques, money market hedge, forward arrangements, currency futures, options, currency swap. They find it kind of a bit difficult in relation to understanding the principle. But I'm going to present this topic seamlessly, right? I'm going to try as much as possible not to make it complex. I'm going to make it very simple. Now, this is what I want to say before we even get into the material. The first thing you need to understand is that there are core principles that underline risk management. There are core principles that underline hedging of foreign exchange risks. There are core principles that underline hedging of interest rates risk. Now, I'm going to emphasize on these principles as and when they come up in our discussion. And your ability to be able to become excellent and be able to understand properly this topic is to be able to identify these principles, because these principles will become the key or the password if you want, in order to open the door to risk management so that you can understand it. It is my objective that at the end of these series of videos that we will be doing in relation to, or lessons that we'll be going through in relation to the topic risk management, by the end you'll be able to now answer questions in risk management, whether it is foreign exchange risks or interest rate risks, because I'm going to present it to you in a way that is easy and simple to understand. So that is what you need to understand. We'll be going through three things. We'll discuss foreign exchange risks, we'll discuss interest rate risks, and then we will end our discussions on hedging techniques. Now, generally, when we talk about businesses for under this topic, when it comes to risk management, are exposed to three types of risks. So let's begin from there. So types of risks. One, we talk about transaction risk, TR. Two, we talk about translation risk. Unfortunately, that is also going to be TR. And then three, economic risk. So transaction risk, translation risk, and then economic risk. So what are they? Let's look at them quickly. Transaction risk is the risk that a transaction in a foreign currency at one exchange rate is settled at another rate because the rate has changed. So in a nutshell, when we talk about transaction risks, it is a risk that a company will be paying a higher amount of money because of the differences between the settlement date. What do I mean by that? For instance, if the exchange rate now is 4.520, now I'll come to the exchange rate in a moment, 4.5290, and you buy goods now, but then you can pay the goods in 3 months time. So you don't pay the goods now, and you pay the goods in 3 months time, and by the time you get to the 3 months time, the currency has further depreciated, and so it is around 4.920. You realize that you'll be paying more than how much you would have paid. So the difference between the purchases and then the settlement date is what we refer to as what? The transaction rate. So it is the rates that we are going to be paying more, or there is going to be a negative movement in the forex exchange rates as a result of the difference between the settlement date and then the purchases date. Now we will come back to transaction rates in a moment. Then we come to translation risk. Now the translation risk can also be referred to as accounting risk. Now this is what you did when you were doing corporate reporting and you were looking at group structure and you're considering foreign subsidiary. You realize that translation risk is the same as accounting risk. Now it is the risk that when we translate, right, the foreign subsidiaries accounts into the domestic account of the parent company, there is going to be a negative movement in the currencies. So if you remember corporate reporting carefully and the foreign transaction carefully, you realize that when we are preparing the group financial statement, that is the group income statement and the group statement of financial position, you realize that we translate the balances from the foreign currency into the currency of the home country. That is what we do. So that is what refers to as what? Translation rate. So in that translating of the records from the foreign currency to the domestic currency of the parent company, the possibility that there is going to be a negative movement in the currency is what refers to as translation rates. So you are translating from one currency to another currency. Then the last one is economic risk. This refers to the change in the present value of future cash flows due to unexpected movement in foreign exchange rates. So there is a change in the present value of future cash flows due to unexpected change in foreign exchange rates. Our focus at this level is not to consider the issue about translation risk. As I mentioned, that will be discussed in corporate reporting, or that has been discussed in corporate reporting. Our objective also here is not to look at the issue about economic risk, because that will be embedded somewhere else in the business. But our focus here is to look at transaction risks, how we will be able to solve the issue about transaction risks, because it is the transaction we undertake, right? The goods we buy, the goods we sell, that really affects us in relation to foreign exchange risk. It is the transactions we want to undertake that would enable us, or that will motivate us to go and borrow money, which may lead us into going into interest or being affected by the interest rate risk. So our objective here is not to look at translation risk, it's not to look at economic risk, but we are going to be focusing our objective from here till the time we end the subject on the first one, which is the transaction risk. Now, so having had these, let's now look at the foreign exchange market. Now, if you have already forgotten everything I've said in the last 60 minutes, 20 seconds, then please, it's good. You can forget them. But what I'm about to say here, it's going to be critical. So you make sure you listen to this carefully and make sure you understand what I'm about to say here carefully. Because your success in risk management, your success in being able to answer any question in the exam hall and also advise companies on risk management, whether forex exchange or interest rate risks, is going to be dependent on your ability to understand what I am about to share with you. So make sure you pay attention and make sure you understand this once and for all, so that when we begin to unfold it up, you will be able to follow it seamlessly and understand it without struggling. Now, the foreign market is usually known as the forex, all right? It's usually known as the forex. Now, so when it comes to the forex here in Ghana, it is called the Ghana Stock Exchange Market. So we have the London Stock Exchange Market, also in London, right? Then we have the New York Stock Exchange. So we have a lot of stock exchange. That is the forex market. Now, for the purpose of how the examination is, we're going to be dealing with the issue about exchange rates. When we talk about the exchange rate on a given day is referred to as the spot rate. Get that carefully. The exchange rate on a given day is referred to as what? The spot rate. So if you walk into any forex bureau, you walk into any bank right now, and then you want to exchange any currency at all, the rate at which they will exchange the currency to you right now, today, is what we refer to as what? The spot rate. So the spot rate is the given rate on a day or when a currency is being exchanged. Now, it's very important because that is the first step. In the examination, exchange rates are always quoted in this way. So there are two ways that exchange rates are quoted, and you have to be able to understand this. So this is where the journey begins. So make sure you understand. So for instance, I'm going to have this. Let me come down a little bit. 1.6250 to 1.6310. Now we always going to have the low rate here and then the high rate here. In the exam hall, that is how the exchange rate is going to be quoted. Now, when the exchange rate is quoted like this, what is the meaning of the exchange rate? One, when the exchange rate is quoted, it is always the amount, so I'm writing it down, the amount of the first mentioned currency that is equal to one of the second mentioned currency. Please follow me carefully here. When the exchange rate is quoted like this, it is always the amount of the first mentioned currency that is equal to one of the second mentioned currency. What does that mean? It means if we have this exchange rate and we are at the low point, it means 1 pound, one pound, it's going to be equal to $1.6250. So it is the first mentioned currency that is equal to one of the second mentioned currency. This is the first currency, dollar. This is the second currency, pound. So 1 pound is equal to whatever rate that has been provided here. That is a principle. That is a principle, and you must make sure you understand the principle. Always, when the currency is quoted like this, the first thing you need to understand is that the first mentioned currency is equal to one of the second mentioned currency. Or, if I should say a dollar, Ghana cedis and dollar, then I say 1.532. That means $1 equals 1.532 Ghana cedis. So the rate is equal to one of the second mentioned currency. That is the first thing you need to understand. That is a principle, and I hope you get it. I hope you get it. So that is the first thing. Once the rate is quoted, we must understand that one of the second mentioned currency is equivalent to whatever rate is given of the first mentioned currency. Now, not only must we understand that the rate is equivalent to one of the second mentioned currency, we must also understand when to use the high rate and when to use the low rate. Now, to be able to do this, we can look at it from the perspective of the customer, that is the business, or we can look at it from the perspective of the forex, or if you want, the bank. In looking at that, what we do is that the lower rate, if we're looking at it from the perspective of the business, is buy or sell, and this is sell or buy. What does that mean? It simply means that if we're looking at it from the perspective of the customer will buy the first mentioned currency at the low rate, and the customer will sell the first mentioned currency at the high rate. Please, another principle here. Another principle. So you make sure you understand this, because this is what will help you to be able to determine which of these two rates you are going to be using. So if we are looking at it from the perspective of the business, they are going to be buying at the low rate the first mentioned currency, and they are going to be selling at the high rate of the first mentioned currency. Then, when we come to the forex perspective, they will sell the first mentioned currency at the low rate and buy the first mentioned currency at the high rate. Now, sometimes some authors present the idea that always the second mentioned currency is the domestic currency or the base currency, that is the currency for the company or the currency for the country in which the company is. But I don't want you to only understand that, because the examiner can exchange it. So even though we assume that almost all the time the base currency is the second one, it is not always like that. So all I want you to understand is whether there is Ghana cedi first and there is dollar second, or there is dollar first and there is Ghana cedi second, or there is dollar first and there is pound second. What you need to understand is that if you are going to be operating from the forex perspective, from the bank's perspective, they will always sell the first mentioned currency at a low rate, and they will always buy the first mentioned currency at a high rate. This is a principle you must understand. Now, to be able to make it clear for you, what you need to understand is you must adopt one of them. So if we are going to sell, then the bank will buy. Now, so let me give you an example. Now, we will get to questions in a moment, but let me give you an example. Let's say, for instance, we are in the UK and we are going to be receiving $100,000 from a US company or from a foreign company. When we receive $100,000, this is the rate. So when we receive $100,000, this is the rate at which they buy or sell the first mentioned currency. So when we receive the dollars, we will sell the dollars to the forex, and they will buy it from us at a high rate. So be careful. When we receive a foreign currency and we are exchanging it, we will sell the currency to them and they will buy from us. So when we are selling the currency, when we are giving them a currency, then they will buy. And so they will always buy at a high rate. Very, very important. However, when we need dollars to pay for goods that we have bought or to pay for something in a foreign currency, we will go there and buy the currency from them. So this is the rate. The lower rate is the rate at which they will sell the first mentioned currency for us, the dollars. So when they are selling the dollars for us, they will sell at what? A lower rate. So they will sell it to us and we are buying. So these are what you must understand about the principle. So what did I say? Two things that you need to take away right now and understand. One is that when the currency is quoted like this, it is always the first mentioned currency that is equal to one of the second mentioned currency. So what did I say? I said if it is quoted like this, it means the second currency, which is a pound, will be equal to whatever rate that is given to us here in relation to that. Then second, you have to operate from either the customers or the business perspective or the forex perspective. Whichever way you stand, you will write. But it is the rate at which they will exchange the first mentioned currency. So if we need money to make a payment, then they will sell that first currency we need to us. So they will sell at a lower rate. If we need money, or if we are receiving money and we are selling the money to them to exchange, then they will buy the money from us. So they always buy at a high rate and sell at a low rate. Now, the conception that we've had always is that people begin to have a couple of ideas to compare it to the exchange rate. Now, please don't go any far, all right? I just want you to look at this for the perspective of the examination. This is what will happen in the exam hall. And if the examiner is quoting it like this, you have to know which rate you need to use. If it is a standard rate like this, here you will still use that same rate because there is no spread. Because the difference between this is the spread. The high and the low is called the spread. So if it has a spread like this, the high and low, you must know when to use the high and when to use the low. So this is the first principle that you need to understand, that always whatever that is quoted is the first mentioned currency that is equivalent to one of the second mentioned currency. Then you must know when to use high or low depending on what perspective you are at. So having got that out of the way, let's look at some illustration and see what we can do in relation to that. So example 1. A PLC receives $100,000. So they are receiving $100,000 from a customer in the US. The exchange rate is 1.6250 and 1.6310. Required. How many pounds will a PLC receive? So get it well. The examiner is asking us how many pounds would it receive. So here we will assume that the company is in the UK, so we can say the base currency is UK. So what did we say? We said that this is the high rate, right? And this is the low rate. And we said that if from the forex perspective, the high rate is the rate at which they buy the first mentioned currency, and the low rate is the rate at which what? They sell the first mentioned currency. So if you look at this, we will be receiving $100,000. So if we receive $100,000, what is going to happen to it? When we receive $100,000, we will sell it to the forex. We will sell it to the bank, and the bank will buy from us. And when they are buying, they always buy at what? The high rate. So we say that a pound is this $1.6310. So if a pound is $1.3690, how much pound will $100,000 be? Sounds good? How many pounds will $100,000 be? So what do? We divide, right? So the amount to be received in pounds will be equal to $100,000 divided by 1.6310 to $1, and that is going to give us 61,312 pounds. So you see it? This is what you need to understand about that. So this is how we work our way out in relation to that. So we are receiving $100,000. We will sell it to the forex, and they always buy at the high rate. And so when we do the arithmetic, we need to divide, and so bam, we get our answer right there. Let's go to another question. Question 2. Jim Jam is a company. Jim Jam is a company based in India, where the currency is the Indian rupee. So let me clean my board. So Jim Jam, it's a company based in India, where the currency is the Indian rupee, IR. So the company is in India, and the currency is Indian rupee, IR. They owe money to a supplier in Eurytania, where the currency is Eurytania dollars. So the supplier is in Eurytania, and the currency of Eurytania is the Eurytania dollars. The amount owing is 240,000 Eurytania dollars. It means Jim Jam should make a payment of 240,000 Eurytanian dollars. Okay, this is how much we owe them. Then look at something. The current exchange rate is, so we have the exchange rate as this. $8.6380, 9.2530. So, required. How many Indian rupees will Jinjam have to pay? How many Indian rupees will Jinjam have to pay? So, now let's look at the question again. The first question we solved, we realized that the company was in UK, and so the exchange rate was quoted as this, right? The pound was second, and then we had how do we call it? The dollar as first. But if you look at this one look at this one here, the company Jinjam is based in India, where the currency is the Indian rupee, and they owe a supplier who is in Eurytania, where the currency is the Eurytania dollars. But look at how the exchange rate has been quoted. So that is why, that's the reason why I told you earlier that even though sometimes some authors think and say that the base currency is always the second one, it is not always so. So if you look at the currency here, you see that Indian rupee is first, which is the country in which we are, and then the foreign currency is second. So don't assume that the second currency is always the base currency. That is an assumption I don't want you to take, because when you take that assumption, then you are going to be wrong totally. So you just have to find out that, okay, if this is how it is quoted, that means that one Eurytania dollars is equal to whatever rate of Indian rupee. Second, the examiner is asking us, how many Indian rupees will Jinjam have to pay? So now Jinjam would have to carry some amount of Indian rupee in order to get 240,000 Eurytanian dollars. Now, what is the exchange rate? The exchange rate is that this is the high, right? And this is the low. So high will always be buy from the forex perspective, low will always be sell. So this is the rate at which they buy Indian rupee. This is the rate at which they sell Indian rupee. So if you look at the scenario carefully, you will realize that the examiner is asking us, how much Indian rupee must we pay? Now, so if we are paying Indian rupee, that means the forex is going to buy the rupee from us. Because if we must pay, then they will buy the rupee from us, because the first mentioned currency is the rate that they buy or the rate they sell. So if they are going to buy the Indian rupee, then they will buy it at the high rate. Very, very important. So if they will buy at a high rate, then what do we say then? We say that 1 Eurytania dollars equals 9.2530 Indian rupee. So let me put that well carefully. So 1 Eurytania dollars equals 9.2530 rupee. So this is the rate. And how much money do we need? We need 240,000 Eurytania dollars. So Eurytanian dollars 240,000 will be equal to how many rupee? So cross multiplication, this time around we multiply. So when we multiply, what do we say? Now, okay, let me just put it down there. So amount to be paid will be equal to 9.2530 times 240,000. And when we do that, we will get our answer in Indian rupee, and we are going to be paying 2,220,720 Indian rupee. So that is the answer to the question. So I want you to look at the first example we solved. We're going to be receiving dollars, so we give the dollars to them and they buy the dollar from us. This time around, we need to pay a supplier, but the exchange rate is quoted in such a way that it is not about a foreign currency, but rather it's about a domestic currency. So they've given us the rate at which they buy, the rate at which they sell. So we multiply, and then we get our answer to be 2,220,720 Indian rupee. I believe that these two examples have set the pace for you to be able to begin to have an understanding of what we are doing here. Then let's look at another example, which is going to be a bit detailed in relation to that. So let's look at example 3. Bulldog Limited, a UK company, buys goods from Redland, which cost 100,000 REITs, the local currency. So let me try to write the preambles down, right, so that we begin to understand what's happening. So Bulldog Limited is a UK company, all right? That means we are assuming that we are in the UK, and they buy goods from Redland. So we are in UK, and certainly if we are in the UK, our currency is going to be the pound, and we are buying from a company in Redland when their currency is REITs or REITs, depending on the REITs, when the currency is the REITs. The goods are resold in the UK for £32,000. So when we buy the goods, we will sell it for £32,000. At the time of the import purchase, the exchange rate for REITs against sterlings, so REITs or REITs against the pound is 3.5650 with a spread 3.5800. So this is the high, the buy rate, low, the sell rate from the forex perspective. So let me take the question over again so that we get the idea. Bulldog Limited, a UK company, buys goods from Redland, which cost 100,000 Reds, the local currency. The goods are resold in, so the cost of the goods is 100,000 Reds. And the goods are resold in the UK for £32,000. At the time of the import purchase, the exchange rate, in other words, when we were buying the goods, the spot rate was this. Required. A. What is the expected profit on the resale? A. What is the expected profit on the resale? Then there is a B there. The B says, what would the actual profit be if the spot rate at the time when the currency is received has moved to I? And they've given us, so B, what will happen, BI, when the exchange rate has moved to this? Or II, So the examiner is asking us what will happen if the exchange rate has moved to this. Alright, so let's look at how we can solve the question together. I guess you can try this question, right? So if it is possible, pause the video and just make yourself dirty in the questions more, then we can continue with it. Right, so how did you go about it? Were you able to try it? Let's solve it together and see what is happening. The A aspect of the question is, what is the expected profit on the resale? What does that mean? If we should buy goods for 100,000 reds and sell it at 32,000 pounds, and then the exchange rate is this, what will be the profit on the resale? So what is going to happen here? It's like we are preparing a profit statement extract. Okay, so A, profit or loss on resale. Profit on resale. I don't know, somewhere, somehow they know we make a profit. So pound. So the revenue from the resale will be brought, and we are told that it's going to be what? 32,000. 32,000. Then we are told that the goods cost 100,000 reds. Now, if the goods cost 100,000 reds, look at the exchange rate. So the high will be the rate at which they will buy the first mentioned currency, right? The first mentioned currency, and then the low will be the rate at which they will sell the first mentioned currency. Make sure you get that. So what is going to happen here? Once we have buy from someone, then we need to get the foreign currency to pay them. So if we need a foreign currency to pay them, that means Bulldog Limited will go to the forex market, right? Bulldog Limited will go to the forex market, and when we go to the forex market, we will go and what? Buy the reds. So when we are buying the reds, the forex is going to sell to us, and as always, the forex is going to be selling at what? The low rates. Okay, the forex is going to be selling at a low rate. So if the forex is selling at a low rate, what do? You know that a pound will be equal to 3.5650 rates, right? So how many pounds will 100,000 rates be? And you know that when we do the cross multiplication, we will have to divide. So we will less the cost of the goods, and that is going to be 100,000 divided by 3.650. So 100,000 divided by 3.650, that will give us 28 and 50.49. So when we less it, we're going to get expected profit when we less that, that is going to give us 3,949.51. So this is how much we will get for the goods. So that is the A aspect of the question. I hope that it's very easy, right? So you bring the revenue 32,000, and then you bring the cost, because we are going to be buying, and so they would sell to us at the low rate, and then we will get this answer right here. But the B aspect of the question, the examiner is saying, or is asking us, what will the actual profit be if the spot rate at the time when the currency is received has moved to I? So if it has moved to I, what will happen? In I, this is still low, this is still high. So we will still be looking at what? The low. So when we are taking the low, BI. So if you are taking BI, our revenue will still be 32,000 pounds. But the cost will now be, so we less the cost, still 100,000, but this time around it will be divided by 3.0800, and that should give us an answer of 32,467.53. So when we subtract, we are actually going to be making a loss because it's bigger, and that will be a loss of 467.53. Sounds good? So it means that if at the time we are actually paying, so if we don't pay now to make this profit and we wait and pay the money later on and the exchange rate has moved to this high situation, that means we will be making loss on this transaction. So this is where the issue about hedging comes in. Now I'm not going to do the II. I would want you to do the II as an assignment and then you can send it up to me, right? So with the II, you will just divide the 100,000 by 4.0650 and the answer should be a profit of 7,399. So yes, in the II our profits will increase, but in the II our profits will reduce. We will actually be making losses. So this is the idea you need to understand about what we do in relation to dealing with forex exchange. So this is what we talk about: transaction risks. But as I said, all of these things have to be solved, because if you look at a second scenario like this, we are making a loss. Can you imagine that? We're making a loss, and who is in business to make losses? No one. As such, we would want to find out ways and means so that we can deal with this issue and hedge ourselves, prevent ourselves from it. And there are a lot of methods that we can use when we talk about hedging techniques, and in the next lesson we will be discussing the various hedging methods that we have to use as a company in order to hedge ourselves. So really, when we talk about hedging, we can just say that it refers to the fixing of a price in the future of either a commodity, a foreign currency, or an exchange rate today. So hedging simply has to do with making an arrangement either with the forex, either with the market, either with another company